Welcome back to the deep dive. Our mission here is, well, it's pretty simple. We sift through the most complex sources, pull out the critical knowledge, and give you that competitive edge. Today, we are wading into a topic that most people only really connect with personal tragedy death. But we're focusing on the staggering financial shockwave it can send through a business.
Exactly. When we talk about business life insurance, especially in, the Canadian small business world, we're not talking about a policy for your family. We're talking about securing business continuity. It is pure risk management. Our sources today are really clear on the core objectives. We're looking at how this insurance protects a business when a key person or a shareholder is suddenly gone, and how it provides the cash to, say, enforce buy-sell agreements, or even act as a specialized employee benefit. It's basically an internal financial shock absorber.
Okay, let's unpack this. Our materials highlight four major impacts, non-personal impacts, that the death of a founder or an essential employee can have. And if you're running a smaller operation, these risks, they're not theoretical. They can be financially ruinous if you don't plan for them. Let's start with the most obvious one, the sudden loss of skills.
Right, and this all centers on the key person.
Yeah.
You really have to think about who this person is in your own organization. It's not just an executive. It's that one individual whose knowledge, whose contacts, whose talent is just integral to your profitability.
And they can't be easily replaced. Not quickly, anyway.
Not quickly at all. We're talking about the VP who holds all the proprietary knowledge, or that one specialized engineer, or the charismatic sales leader who clients just adore and follow.
And when that person dies, the operational fallout it's immediate. You see a dip in production, your expenses shoot up trying to find a replacement, consumer confidence drops, and, well, revenue takes a nosedive.
Take the example of Monica, the architect from our sources. She works for a mid-sized firm. The owners looked at their books and they realized something pretty startling. Roughly 30% of their total revenue was directly tied to clients who specifically wanted Monica's unique, award-winning style.
30%.
30%. So losing her isn't just losing a salary on the books. It means they lose almost a third of their earning power overnight, all while they're scrambling to manage her old projects and find someone who, let's be honest, might never replicate her specific draw.
A catastrophic loss like that, 30% of your revenue just gone. That doesn't just hurt internally. It makes the company look really unstable to outsiders, which brings us to the second impact, creditor demands, specifically something called the demand loan.
Oh, this is a devastating one. And it's so often unexpected. Demand loans, like lines of credit, are very common. The key thing is they have no fixed term. The lender, the bank, can recall the entire loan and demand full repayment, sometimes with very, very short notice.
I understand the operational loss is bad, but I wouldn't have thought a death could literally bankrupt a company through a loan recall. How does that work?
It all comes down to perceived viability.
No liability.
Exactly. The bank issued that loan thinking performance would be stable, continuous, and that stability was often tied to one person. When that key person dies, the bank looks at the loan again. They see that 30% of revenue vanishing, they see a leadership vacuum, and suddenly
The risk is too high.
the risk outweighs the return. They lose faith, and they call the loan.
We have the example of Cooper. He was a senior sales director for an ad firm. He was responsible for a staggering 50% of all new business.
50%. And the firm had just taken out a $500,000 demand loan. They were investing in some really risky new holographic advertising tech, and they were banking entirely on Cooper's ability to sell it.
And then he passed away unexpectedly.
The bank looked at the sales projections, saw that future revenue just evaporated, and they immediately recalled that $500,000 loan.
Wow. So just days after losing their top earner, the company is hit with a $500,000 liquidity crisis.
Forcing them to either find the cash immediately or liquidate the very assets the loan was supposed to buy.
That pressure must be incredible, dealing with grief, operational failure, and now a massive debt. But the turmoil isn't just external, it often comes from inside the company, which is our third impact. Family member interference.
Yes, this is what happens in a shared ownership business. An owner dies, their shares pass to an heir, a spouse, a child who might have zero business sense.
Or just isn't compatible with the surviving partners.
Right. Let's talk about Jason, Ivan, and Connor. They owned a funeral home together. Restful Solutions.
Jason passed away, and his shares went to his 24-year-old son, Mason. And Mason was described as a troubled young adult. No prior involvement in the business.
None. And he suddenly inherits a stake in this complex, sensitive business, shows up demanding to take over his dad's role, and, well, he was often in an unstable condition.
To the surviving partners, Ivan and Connor, they told him no.
And Mason just dug in. He demanded an unreasonable price for his shares, $1.2 million, knowing they didn't have that kind of cash.
So he held them hostage.
Essentially, yes. Forcing them into a massive, unwanted financial transaction just to buy out a hostile partner who could have sabotaged the whole business.
That just screams the need for a buy-sell agreement and, more importantly, the money to actually fund it when you need it.
Precisely. Which brings us to our fourth impact. It's the flip side of this problem, achieving equality for family members in succession.
Right. This is that classic challenge for owners who want to treat their kids fairly, which doesn't always mean treating them exactly the same.
The issue really pops up when the business is the single largest asset.
Yeah.
Maybe one child is committed to it, loves it, and the other has a totally different career. You can't just split the company in two without destroying it.
Our sources use the case of Christina. She owns Hibiscus Garden Center, it's incorporated, worth about $1.5 million. Her son, Harry, loves the business. He's worked there his whole life. He's the obvious successor. But her daughter, Nancy, is a doctor. She has zero interest in running a garden center.
Right. And Christina's only other liquid assets are about $400,000. So if Christina just leaves the $1.5 million business to Harry, and Nancy gets the $400,000.
Nancy has been treated unfairly, at least in terms of financial value.
The courts would certainly see it that way, yes.
But hold on, if she gives Harry the business, isn't she giving him a job, a career? Shouldn't that count for something? How do you even quantify fairness there?
Well, the courts look at the tangible value. Harry gets a career, sure, but he also gets the debt, the responsibility, the future risk. Nancy gets a static $400,000 cash equivalent. The solution is finding a way to give Nancy cash equal to Harry's inheritance without forcing Harry to sell the business to pay her off.
A classic liquidity problem.
That life insurance is perfectly designed to solve.
Here's where it gets really interesting, because we're about to pivot from operational risk and family drama to the serious financial and tax risk that's baked right into the Canadian system. It makes this whole liquidity problem so much worse.
That's right. The single largest financial shock for an illiquid estate after a death comes from the capital gains tax. In Canada, the rule is, upon death, you are legally deemed to have disposed of all property, including business shares, at fair market value.
Right before death.
Exactly. And that instantly triggers capital gains tax on all the appreciation unless there's a spousal rollover.
So the government is basically saying, even though you didn't actually sell your shares, we're going to tax you as if you did. That seems brutal.
Especially if the estate has no cash.
It is brutal, and it forces immediate action. Let's look at Lori. She owns a 20% interest in a corporation. Her adjusted cost base, or ACB, is $100,000.
Okay, hold on. Let's just squeeze there for a second. ACB, FMV, can you break those down for us? For sure. So the adjusted cost base, the ACB, that's basically what Lori originally paid for those shares. It's her cost for tax purposes.
Right. The starting point.
The starting point. And the fair market value, or FMV, is simply what those shares are worth on the market today.
Okay, so Lori's ACB is $100,000, but the current FMV is $600,000.
Correct. So that's a $500,000 appreciation. In Canada, only half of a capital gain is taxable. So that's a taxable capital gain of $250,000. If her marginal tax rate is, say, 50%, the tax liability is $125,000.
$125,000 due immediately, just for dying.
Exactly. And if her estate, her daughter, maybe doesn't have that $125,000 in cash sitting around, the executor might have no choice but to sell those shares. The business might have to be sold, even if the family wanted to keep it.
This makes it so clear why the business structure is vital to this whole conversation. If Lori had a sole proprietorship, for example, the business just ends when she dies. But the assets are still subject to that deemed disposition.
And with partnerships, the interest can be bought or sold, but you still trigger the capital gain. And the big risk there is liability partners are often jointly liable for all the debts. Corporations, though, they're separate legal entities. That gives you liability protection. But those corporate shares have an ACB, and their disposition at death is where that capital gains tax problem really hits hard.
But there is one very powerful tool in Canada to help with that tax shock. For small businesses, anyway. The CCPC, or Canadian-controlled private corporation.
This is a huge benefit for Canadian entrepreneurs. It's why structuring correctly from the start matters so much. For qualified shares in a CCPC, a taxpayer can use the lifetime capital gains exemption, the LCGE.
And what does that look like in practice?
Right now, it's about $1.25 million. It's indexed for inflation, and it can offset or even completely eliminate the capital gains tax on those shares. It is the single most important tax planning tool for owners of private Canadian corporations.
To really see the impact, let's look at Gene, the owner of Killiman Sportswear, a CCPC. The deemed disposition when he died resulted in a capital gain of $400,000.
Okay, if his executor didn't use the LCGE, assuming a 45% tax rate, that would create a staggering $90,000 tax bill for his daughter to cover. But if they had planned properly, and the executor uses just $250,000 of that available $1.25 million exemption,
The taxable gain plummets.
it plummets. His final tax bill drops to about $33,750. That's a saving of over $56,000 just from strategic planning.
It's so clear that an owner's death creates this perfect storm of financial demands. You've got operational loss, debt recall, partnership fights, and this huge immediate tax bill. And all of these risks seem to point to the same strategic solution, using life insurance to create immediate tax-free liquidity.
Let's start with the most direct solution for that operational loss. Key person life insurance. The mechanics are very simple. The company buys a policy on that key person on your Monica or your Cooper, and it names itself the company as the beneficiary. When the insured dies, the death benefit is paid to the company tax-free.
And that cash infusion is crucial for stabilization. It's not just a payout, it's continuity capital. You can use it to fund this search for a replacement, cover training, make up for that lost revenue, or just pay the bills, rent, salaries, until the company gets back on its feet. It buys you time.
Exactly. Then you get into more complex scenarios, often using what's called a split dollar arrangement. This is a pretty sophisticated way to share a permanent life insurance policy, its costs and its attributes, between two parties, usually the employee and the corporation.
That sounds complicated. Why would two parties want to share one policy?
For efficiency, the corporation gets the death benefit protection it needs at a manageable cost, and the employee gets access to a really robust, tax-deferred investment vehicle that they might not otherwise afford.
So what's the most common split for key person insurance?
In that case, the corporation would own the death benefit, the capital it needs to cover the business loss. The employee, meanwhile, would own the policy's growing cash value and maybe any excess death benefit above what the corporation needs.
And how are the premiums split fairly?
Well, the CRA's view is that the split should reflect the fair market value of each interest. So the corporation's share of the premium is usually tied to the cost of comparable term insurance. The employee pays the rest. It requires some very careful tax planning, though.
And finally, one of the most practical uses of business insurance is just as a hard requirement for borrowing money.
This brings us right back to Cooper and that demand loan. If a bank is lending you $500,000 and your whole business relies on one person, that lender will often require the business to buy and assign a key person policy to them.
So if the key person dies, the lender gets paid back immediately. It mitigates the risk.
Instantly. And there's an important tax benefit there for the business, too.
Right.
Yes. If the business gets the insurance because the lender requires it, and this has to be documented, the business can actually deduct the premiums from its income. It lowers the effective cost of the whole strategy.
So what does this all mean? If we tie this all together, the big takeaway is that business life insurance isn't a luxury. It's a fundamental tool. It secures continuity, provides liquidity for debt, resolves toxic partnership conflicts, and it strategically handles that massive tax bill from deemed disposition.
So what does this all mean? It underscores just how critical it is for an advisor to understand the client's structure before doing any planning. Are you a sole proprietorship, a partnership, a corporation? The risks, and therefore the solutions, are completely different for each one. That knowledge is the difference between a secure future and the kind of catastrophic liquidity crisis we've been talking about today.
Exactly. This deep dive should really shift your perception of insurance from just a personal safety net to fundamental business due diligence. I mean, consider the extreme financial instability caused by the death of someone like Cooper, the sales director, who triggered that catastrophic $500,000 loan recall. I want you to ask yourself this. How many key people in your current professional network, if they were suddenly gone, would cause a bank or a major creditor to panic and demand immediate repayment? Understanding that immediate high-stakes risk makes the idea of key person insurance feel a lot less like an option and a lot more like a basic necessity for staying solvent.